The FOMC had a meeting. We were actually able to see that growth in the economic activity was picked up in the recent quarters. However, the unemployment rate have declined but remain elevated. And the labor market indicators are mixed, but they have shown improvement. While long-term inflation expectations have remained stable, the current inflation is below whatever the committee is considering to be the longer run objective. The economic restraint, and if we understand this, that the fiscal policy represents, although it's still very much present, has been diminishing over time. The household spending and business fixed investment advanced a little bit, but it needed to be a bit more than what we were suspecting from recent months, while the recovery in the housing sector slowed down somewhat. Now, the committee expects that with appropriate policy accommodation, the economic activity will actually expand at a moderate pace, and that the unemployment rate will eventually and gradually decline. We have to also understand that the committee has been monitoring inflation developments very carefully for evidence that inflation will move back towards its actual objective over the medium term. I'm a big believer that if the committee decided to make a further measured reduction in, say, the pace of its asset purchases, this will become the beginning in February. The committee will add to its holdings of agency mortgage-backed securities, which right now what was said is that at a pace of $30 billion per month rather than the $35 billion per month, and this will add to its holding of longer-term Treasury securities at a pace of about $35 billion per month rather than $40 billion per month. How does this make sense? If income and information broadly supports the committee's expectation of this so-called ongoing improvement in the labor market conditions, and if inflation moving back towards its longer run objective, then the committee will likely reduce the pace of asset purchases in further measured steps at future meetings. The committee has also today reaffirmed its view that a highly accommodative stance of monetary policy will remain appropriate for a considerable time. A considerable time after the asset purchase program ends and the economic recovery, as we call it, strengthens. In light of all this information, it's also been reaffirmed that it's the committee's expectation that the current exceptionally low target range for the federal funds rate of 0 to 1/4% will be appropriate at least as long as the unemployment rate remains above 6.5%. Inflation between 1 and 2 years ahead of what is projected to be no more than a half percentage point above what the committee's 2% longer run goal is. And obviously the longer term inflation expectations continue to be well anchored according to them. With all this information, if the committee continues to anticipate, based on its assessment of the many factors as just mentioned, that it likely will appropriate to maintain the current target range for the federal funds rate well past the time that the unemployment rate declines below the 6.5% as mentioned, especially if what they have projected as an inflation continues to run below what the committee's 2% longer run goal is. Remember, when the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with that of its longer run goals of the maximum employment and inflation of 2%.